Okay, ready? There you go. Welcome. You're listening to Mortgage Investing 101, the show where we discuss high yield real estate mortgage backed investment opportunities. I'm Edward Brown, your host, and I'm proud to introduce my co host, Mark Hanf, president of Pacific Private Money, one of the fastest growing private mortgage investment firms in Northern California. Our goal on this show is to provide information and to increase your awareness of these important alternative investment strategies where you can earn secured high yields using your savings or IRA accounts. And get this, annual yields of 8% or more are not uncommon using the strategies we're going to discuss in today's show. If you like what you hear today, you can call Pacific Private Money at 415-883-2150 for more information, or go to pacificprivatemoney.com. You can also check out our website at mortgageinvesting101.com, the name of the show. And for fun, we're going to have trivia contests where before each commercial break, we're going to be asking a trivia question, and the first three callers with the correct answer win a free 3-day, 2-night stay vacation. The vacations are not sponsored by the radio station, but by Lighthouse Resort and Marina, which is located 1 hour northeast of San Francisco. The vacations are free. The Lighthouse is only requesting a $75 cleaning fee to cover housekeeping expenses. Check them out at lighthouseforfun.com. Today's trivia theme is the movie Back to the Future, and specifically Doc.
Oh,
and we'll have some fun with that.
Yes.
Okay, so Mark, today, first of all, the name of the show is Mortgage Investing 101. So give us a little brief background as to what that is.
So, Edward, good morning. Happy Saturday to everyone out there listening, driving around the Bay Area, and or maybe at home doing some honeydew projects with the radio on in the background, which I like to do on the weekends.
I do.
Anyway, Mortgage Investing 101 is the name of the show. We've been doing this show now. This is our 4th month. I think we've got like 15 or so podcasts on Mortgage Investing 101. So if you only hear snippets of this show or you want to hear more, listen at your convenience. Go ahead and listen to any number of recent podcasts at mortgageinvesting101.com. So we started this show kind of as an offshoot to our sister radio show, which is called The Best of Investing, where we talk about all kinds of investment strategies, not just real estate and mortgage investing or trust deeds, but also stocks and bonds. And we have guests on and such. But we decided let's do a separate hour and just talk about the strategy of mortgage investing, because we've been doing Best of Investing, the other show, for over three years now.
Yeah.
And so I get a lot of calls early on, or actually throughout the week, from people who heard our show on the weekend, and they're asking about mortgage investing. So the goal of this show is just to talk a little bit about what it is, because what I'm finding out from the public is that even though I've been working for the last 5 years at Pacific Private Money, originating loans to real estate investors and funding those loans with private capital, the people that I work with who love using their capital to fund these loans and love the returns that they're able to achieve with that, it's a very small niche investment market, and the vast majority of the public is actually unaware of just how great this can be, because there's safety and security features, which we'll talk about a little bit later in the show, that make mortgage investing, also known as trust deed investing or private lending, or also mortgage pool fund investing, which we'll talk about. The Pacific Private Money Fund is a mortgage pool fund. That's one of the investments we offer. Any one of those types of investments, we kind of wrap up into the genre of mortgage investing. And mortgage investing is just not something you read about much in the paper at all. In fact, I almost never come across an article about mortgage investing in the newspaper, the Wall Street Journal, or the business publications. And if you ask your financial advisor or financial planner about it, he's probably going to feign ignorance and say, "Oh, you mean REITs, right? That's what you want to invest in." So, and the reason why, it's not because your financial planner's a bad guy. It's just that it's not a publicly traded, over-the-counter, as they call it, stock or bond or mutual fund, where they can earn a commission on it.
Except that, you see, it's not publicly traded, but in your fund, there are liquidation procedures.
Yeah, I didn't say it's not liquid, but it's not publicly traded, and it's not liquid like a stock. You can't necessarily get out of it tomorrow, but there is a vibrant community, there's a vibrant resale market for individual notes, also known as trust deeds in California. And if you are in a mortgage pool fund, there are redemption opportunities. Now, if you're redeeming before the minimum investment period, which in our case is 2 years, most funds do have a redemption fee, but it's still, you're still going to have a net positive. It's not like you're going to actually lose money. At least not in our fund, Pacific Private Money Fund. We're paying 8.5% on average, and if you redeem within the first 2 years, let's say you try to get out in month 18 because you want to buy a house or something, you need that money that you've got in the fund. Well, it's a 2% redemption fee, so your net return would still have been over 8% during that time period. So again, it's not a loser. But anyway, get back to the gist of mortgage investing. Essentially what you're doing is you're being the bank. Your money, you're allowing your money to be the bank, the source of funding for loans made to real estate investors. And that's a very important point, is that at Pacific Private Money and at other private money and hard money loan origination companies in the Bay Area, in fact throughout California, the vast majority of us focus on the niche lending product of loans to real estate investors, short-term generally, 6 to 12-month loans to people who are buying, fixing, and flipping real estate. In Pacific Private Money's case, the vast majority of our loans are made to rehabbers and contractors in the Bay Area, buying, fixing, and flipping real estate.
Okay, now how safe is that?
Well, if you consider the fact that we typically don't lend higher than 70% of the purchase price, meaning the borrower has to come in with minimum 30% down plus closing costs and have their own rehab monies sized up, there's skin in the game. We don't do 80% or 90% loans like the banks do.
Well, here's the other thing, is that in the beginning, your loan is 70% of, quote, value or purchase price, but because the contractor, let's say in this case, is going to be putting money into the deal and obviously trying to improve it, the value theoretically would be higher because he's trying to make money, so your loan to value is less.
That's absolutely right. But just to kind of continue on with what is mortgage investing, it's a way for you to earn secured yields of 8% or more on your money, and it's secured by real estate. Now, you may not be a real estate investor, and you don't need to be a real estate investor to take advantage of this. Real estate secured loans just happens to be the vehicle we use to create high yield investment opportunities that are both secured and insured.
Okay, so now why wouldn't this contractor in this case, since you're yielding to the investor 8+%, sounds like a high interest rate. Why wouldn't that contractor go to the bank?
It is a high interest rate, and in fact, the note rate, the gross note rate that we typically charge on a loan such as this is 10%. That's more often than not, our loans are generally fall between 9.5% and 10.5%. Usually with an average of 10. And they come to us because in this market, and it's been like this now for several years, speed is what gets the best deal. And so the buyer, the borrower, the rehabber, who's all the same person, this real estate investor is competing against other real estate investors to buy real estate. So in order to get the deal, oftentimes, in fact, more often than not, they have to promise a quick close. Oftentimes they'll promise an all-cash quick close with no loan contingency. In fact, that's a very, very common way that people buy investment property today, is with no contingencies or no loan contingency in a fast close. Maybe it's a 14-day close, maybe it's a 10-day close.
Well, we've all heard recently, maybe it's kind of slowed down, but we've had, like on our other show, Best of Investing, we've had realtors on there who said, we have 30 backup offers.
Well, that's exactly it. So the prize, the contract to purchase this property is more often than not going to go to the easiest buyer. And the easiest buyer is the guy who's going to say, hey, all cash, no loan contingencies, 7-day inspection, close in 14 days.
Now, when he says all cash, what he's really meaning is he's coming up with 30%. You're going to lend him the other 70%.
Right. Most people, or I should say,
cash.
many people who write an all-cash offer really intend to use a hard money loan, and sometimes that will irk the listing agent or even the escrow officer. But we've actually never had a deal collapse as a result of us coming in last minute, so to speak, with a hard money loan.
Okay, so it's nothing squirrely going on.
It's nothing squirrely. No, it's just that this is how we usually get involved in helping real estate investors buy real estate is by coming in with a very fast loan, and fast again is anywhere from 5 to 10 business days, 1 to 2 weeks. There isn't a bank in California that can accommodate that speed. They're just not geared to provide that kind of level of service.
Okay, and the other reason, if I understand it correctly, is it may not only just be speed, it may be a situation where they had a hiccup on their FICO score because of maybe a short sale that they had 3 years ago, or whatever reason their FICO score is in the mid 600s and not hitting the high 700s. For the
right, that's correct. So there's 3 main reasons why someone would use hard money at 10% to borrow hard money at 10% to buy real estate. 3 reasons. Number 1, speed. We just talked about that. Number 2, you just hinted on that. FICO scores for a lot of real estate investors have been beaten up because if they were real estate investing in 04, 05, 06, very likely they may have bought property that ended up upside down, and they decided not to be a hero and make payments on a property that declined significantly in value. A lot of these guys let these properties go to foreclosure.
Now, in theory, that could happen to your company too, right? I mean, if someone does a loan with you and they decide not to be a hero, but it sounds like since you're only doing 70% loan to value, that actually might be good news.
Well, it can. You can, in theory, make money on a foreclosure, and people that we've worked with over the years have. But let's get back to that in a little bit. The third reason someone would use a hard money loan is because the condition of the property does not allow a bank to make a loan. And so oftentimes a property will be purchased and maybe the former owner or the person living in it before, the tenant, so to speak, may not have left it in very good condition. Oftentimes they will trash the place, though they might even pull plumbing out. I mean, a lot of these homes end up getting damaged and it's just not bank financeable. Or we've done a number of fundings on properties that the remodel started and then stopped and was never finished. And it may have been sitting like that for a couple of years while it's winding through the foreclosure process. And so now they're buying a non-habitable, but clearly an opportunity for a contractor to go in and finish it. And so as long as we can confirm that there's no mechanics lien issues and get clean and clear title insurance on the property, hey, it's a great lending opportunity and a great purchase opportunity for our contractor clients.
Okay, so it sounds like there's just certain rules that the banks have to follow with all the new regulations because of the mortgage meltdown that
right.
they just can't lend. Tell you, we're going to cut to a quick commercial break here, and when we come back, let's get into specific deals that
Sure.
you're working on right now, because I'd like to hear the audience to actually hear exact numbers. We're an exact show here.
That's
so we
right.
want people to really understand what's going on. Okay, here is our first commercial break. Again, you're listening to Mortgage Investing 101 with Edward Brown and Mark Hanf. So far, we've been talking about hard money real estate loans, investments yielding 8% or more, secured by the real estate.
And for more information, give us a call at 415-883-2150. That's 415-883-2150. Go ahead and call today or over the weekend. Leave a message for us. We'll get back to you next week.
And you can always go to mortgageinvesting101.com or pacificprivatemoney.com. All right, here is the first commercial break trivia question. The theme is the movie Back to the Future, and specifically Doc, which, by the way, his van said E Enterprises, which is the name of my company, Edward
Enterprises.
Something like that. Okay. According to Doc, what makes time travel possible? The first 3 callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Their website is lighthouse4fun.com. Call 888-529-1134. That's 888-529-1134 to answer this question. According to Doc, Christopher Lloyd, remember? He's the one who played Doc?
Yes.
Okay. What makes time travel possible? 2 words that we're looking for, specifically 2 words. Call 888-529-1134. That's 888-529-1134. Again, to answer the question, according to Doc, what makes time travel possible in the movie Back to the Future? Make sure to include your name, your email address. Speak slowly. Spell out your email 1 letter at a time, please. Don't touch that dial, because Mortgage Investing 101 with Edward Brown and Mark Hanf. We'll be right back. So
We'll be doing this again on Monday.
Yes. Yes, we will.
That's all right.
It'll be interesting to hear people call from like the Sunday show or the Saturday show or whatever.
Yeah.
Sure.
Oh, that'll be great. That'll be so great. Oh, I totally have just got to figure out how to get my follow-up system in order, get the CRM going here. I'm not trying to put too much pressure on myself to come up with the perfect solution, but it's just really great. Because I actually tried to go into my Outlook and copy and paste the 97 people who are now in the garden and put it to a spreadsheet, and it didn't quite copy and paste. So I have to figure out a different way to maybe export it or something.
Miss some fields or something?
Yeah, well, the fields kind of got all messed up because I was hoping to include the notes field so that you would have the benefit of seeing when I sent, when did I mail the thing to them. And, it's just silly. Look at you. You're like totally set with water here.
Yes. I'm gonna put a spigot up to my mouth.
Do you try to drink like 100 ounces a day or something? Or
Well,
eating?
gosh, I mean, I'm getting a little bit too pudgy here.
Water's the cure-all for
I
anything.
look-
Just drink more water.
Well, I look back at 3 years ago when we started investment investing. I look at some of the pictures. I go, I think I looked better back then.
Your face looks skinnier.
Yeah, I had a little more hair. 3 years. 3 years ago, so pretty quickly.
Yeah.
Okay. Here we go. Welcome back to Mortgage Investing 101. I'm Edward Brown, your host, along with Mark Hanf, president of Pacific Private Money, the fastest growing private mortgage investment firm in Northern California. We'll talk about how fast you are because you're providing you're doing a lot of loans.
Yeah.
Okay, when we got to the first commercial break, we asked this trivia question. Again, the theme is Back to the Future, and specifically Doc. According to Doc, what makes time travel possible?
Said it was 2 words.
Yes.
Is it lightning?
No. The flux capacitor.
Oh.
You remember that? He sticks all the garbage in the flux capacitor.
I love that there's an episode of Modern Family where the ditzy daughter tells the smart daughter, and why do you have that poster of that guy from Back to the Future anyway? It's Einstein, you idiot.
That's right. The name of the dog was Einstein in the movie too. Anyway.
Hopefully you'll get that one, audience.
Okay.
So we were talking last segment about mortgage investing, and just to kind of round out the conversation of what is mortgage investing. As if you listen to the last segment, you heard us talk a lot about the product that we use to create this 8% yield that we're able to offer our clients. And the product is loans to real estate investors, short-term loans to real estate investors who can't get money from the bank because of the fast nature or the nature of their credit. And they're usually paying note rates of 10%. And so why, and just a couple of other nuances about in addition to, it's a great way to earn 8% or more on your money, secured by real estate, insured with title insurance and hazard insurance. The other aspects of it, it's a no fee and no load investment strategy.
Okay, so wait, hold on. So if I invest $100,000, you're telling me that no fees come out of that. My whole $100,000 is going to earn this 8+% interest.
Exactly, because all the fees are paid on the borrower's side. So the borrower, when we make him a $100,000 loan using investor capital, he's not going to get $100,000. He's going to get $100,000 minus the origination fees and any other title and escrow fees that we charge, title insurance, escrow charges, all of that. So he's going to get a net amount, and it might be somewhere in the mid to low 90,000s that he actually receives. But the lender, that entire $100,000 is getting that yield, that the contract yield. In the case of an individual note, let's say it's a 10% note, and the investor is getting 9%. That would be 1 minus the note rate for servicing, and that's a very common method for people to get paid if they're investing in an individual note, or if it's a mortgage pool fund, they're putting that $100,000 into the mortgage pool fund. Once that money is activated, that entire $100,000 is earning money. So there's no fee and no load going in, and then coming out, there's no redemption fee. So unless you're trying to get out early on a mortgage pool fund, there might be redemptions.
So that's probably why my financial planner doesn't recommend this to me,
No
because he doesn't
fee,
get paid.
right? No fee and no load. In fact, we even collect a wire fee because oftentimes what ends up happening is the investor needs to wire their money to the title company or wire their money to the mortgage pool fund account. We'll collect a $30 wire fee and reimburse them for it. So we really truly try to make this a no fee, no load investment that pays you and it'll pay you interest either monthly, quarterly, or in the case of our mortgage pool fund, which pays quarterly, it also has an option to let your earnings compound and buy additional shares. So in the case, for example, if you have a Roth IRA and you're investing your Roth IRA monies or any IRA monies for that matter, and you're not taking distributions, it really doesn't serve you to have the IRA receive quarterly distributions because then it's just sitting there in cash which you have to reinvest. You might as well allow it to ride and it will actually compound your yields. You'll probably get more closer to a 9% return on your money if you're investing in the Pacific Private Money Fund using your self-directed IRA.
Yeah, because it's compounding at 8.5%, which would be closer to about 9%. I got it.
A couple of other nuances is that again, it's mortgage investing is backed by real collateral. Now, I've had arguments with stockbrokers about saying a stock is a contract, it's a piece of paper, it's not backed by real collateral. What do you mean it's not backed by real collateral? Apple's not a real company, and Microsoft is not a real company. It's not that it's not a real company. It's just not collateral that offers you protection of principal, because as unlikely as it is, Apple's probably not going to go out of business, but could their share price go from 400 to 200?
Absolutely.
And
we've seen that before.
Now, of course, someone might say, well, real estate can go from $500,000 to $250,000. Well, yes, that's true, but the types of loans that we're doing are short-term loans. Real estate doesn't go down 50% in 6 months or 12 months. It took how many years for the market to go from when it peaked to when it bottomed? That was about a 4-year process.
But not only that, that's also assuming the borrower walks away. A lot of times these borrowers will still pay even if they're underwater.
Right, and so we make short-term loans to people who are buying, improving, and then flipping real estate. So even if the market does, decide to take another dip and go down, let's say 10% in 2014, it's not going to happen overnight, and it's not going to be that fast where we're worried. We, meaning Pacific Private Money, who's originating these loans, since we're not making long-term loans, we're not really worried about what the market's is going to do between now and 5 years.
Okay, so let me grill you a little bit on this. I'll put you on the hot seat. Okay,
Please do.
so all right, so I'm thinking of investing $100,000 because it sounds like I'm going to get about 8.5+%, which sounds like a very, very good return. Realistically, what are my risks?
So realistically, your risks are, and again, let's talk about deflation. So the banks were exposed when the market tanked between, and I'll use the word tanked. It's a little
sure, that's fair.
If it bleeds, it leads.
Yeah.
So the market corrected. How about that? Considerably.
It fell on the face of the earth.
Between 2007 and 2010. Let's call it 3 years. I said 4 earlier, but let's just say for argument's sake, during that 3-year period, the market corrected, and in some markets it corrected as much as 50%. I mean, depending on where you were in the Bay Area, it was just amazing. I mean, one could make an argument that the prices were artificial that people were getting, appraising at in 2006, the height of the market, versus 2010. But that happened over a long period of time, right? It happened over several years, and the banks were making basically 30-year loans, right? And so the banks were exposed. They were doing 80% financing. In some cases, they were doing 100% financing. So the banks really took it in the shins. They're the ones who and the taxpayer, if you want to basically say that the taxpayer bailed out the banks. So we're really comparing apples and oranges if you want to say, well, what's your exposure today as a hard money lender? So today, we make a loan at 70% of purchase price, not some future value, not some, made-up value, but a real arm's-length purchase price transaction. We lend 70% of that. And again, the money's short-term. We may write the note for 12 months, but we expect it to be paid off somewhere between 4 and 8 months on average.
Yeah, the average borrower doesn't want to keep the high interest. Which, by the way, audience, for those of you who just tuned in, you're listening to Edward Brown and Mark Hanf of Pacific Private Money, talking about hard money real estate loans where you can earn 8% or more on your money secured by real estate. The name of the show is Mortgage Investing 101.
Right, so we're talking about the relative risks of that. So over the course of the 12 months, real estate's not going to go down 50%. It's not going to go down 25%. In fact, it'd be awfully rare for it to even go down 10%. Let's say over
today,
from today over a 6 month.
We're not talking about from 2007. We're
Right.
talking about today's prices.
So when we're looking at what's the risk? So we're looking at one of the risks is that the value of real estate in general or that specific neighborhood where that property was purchased goes down in value. So if it goes down in value, it'd have to go down 30% before you were at break even.
Assuming that the borrower decides not to pay.
Assuming that the borrower decides
a lot
not to
of
pay.
borrowers still pay even if they're underwater because they're hoping for the market to return.
And then beyond that, the other risk is, well, maybe the borrower stops making his loan payments and now we have to foreclose on the property. And I say we, meaning if it's an individual note, you as the lender would have to make that decision and actually bear the cost of foreclosure. There'd be two costs. One is you're not getting a monthly interest payment anymore on that loan, although your interest is accruing, you still have the right to collect it. But number two, there's a cost of foreclosure, which is usually a little more than 1% of the loan amount. So you would have to pay that money up front to a foreclosure company and have them start the process, which in California is a 4-month process. Now, we're talking about the risks. Well, that doesn't necessarily mean you're going to lose money. And in fact, if we did our work correctly in terms of the valuation and everything was arm's length, that very likely, in fact, there's a strong possibility that you're going to foreclose on property that's worth more than your loan, and you will either end up owning that real estate and then you can sell it or improve it or move into it or do whatever you want with it, or what's more than likely going to happen is someone at the trustee sale will actually purchase it and reimburse you in full for not only your principal but accrued interest, late fees, default interest, all the extra fees that get added on there when someone doesn't make their payment. So there's a risk that you won't receive the monthly interest. So I tell people
it's just delayed though.
Right. I tell people that if you absolutely need that monthly income, trustee investing is probably not the best investment for you. There are better investments that have absolute reliability of monthly or
my checking accounts that pay zero.
Right. Well, I'm not saying you're going to get high interest. I'm just saying.
Wait, under my mattress, that money pays zero too.
But if you're a person out there, and let's face it, many of us are this person who really needs to figure out a way to increase, on average, the annual yield of their investment portfolio. I mean, really, who out there listening doesn't need to boost the yield?
Oh, everybody does. Let me go back for just a quick second, because you said if I absolutely have to rely on this income, this may not be the investment for me. But however, if I invest in your fund, isn't it diversified over a number of different loans, and the odds of all of them going down in one shot are unlikely?
Very true. So we're talking about mortgage investing in general, and mortgage investing includes individual note investing, also called trustee investing, and it includes investing in mortgage pool funds, which at Pacific Private Money we have our so-called Pacific Private Money Fund, which is currently paying 8.5%, actually 8.9% as of the third quarter. And so when you invest in a mortgage pool fund, the risks there are that the biggest risk in a mortgage pool fund, let's face it, we all read the newspapers. There are guys out there that have managed through their personality to convince people to invest in their shady little deals.
You know what? That just hit the paper this last week.
Yeah, there was another guy in Marin County that apparently he raised $2.5 million from, I guess, some neighbors. In fact, he lived in a neighborhood that I used to live in.
Oh, really?
So I didn't recognize the guy's name, but it just amazes me that these guys, and usually when this happens, with the exception of Bernie Madoff, that's like the exception to what I'm going to state right now, which is most of the time when you read about these guys who have made off with other people's money, it's usually like a lone wolf type of guy. He doesn't generally have a well-known or reputable company or have an office that's staffed up with people. He certainly doesn't have associations with organizations, third-party organizations that are kind of oversee. They may not even have partners. It's usually just one guy, right?
Well, okay, that leads us right into that then. You kind of opened yourself up. Okay, so why are you different?
Well, we're different at Pacific Private Money because we, first of all, we have several people involved in like the committee process for the assessment of the type of loans we do. We've got a staff right now. We've got a staff of 8 in our downtown Nevada Marin County office, and we use a third-party fund administrator who does daily reconciliations of the fund dollars and bank accounts. And so if I were to decide, you know what, I'm just going to take this money and go to Chile or wherever, it would be discovered immediately, and it would be a little bit difficult to get away with something like that. And so again,
Also, you get audited too, don't you?
well, we've got the annual audits, of course. Of course, an annual audit doesn't help you if you've got the ability to cash out. But the other part of it, and again, this is really more anecdotal than anything else. But in our case, everyone who works for the company is with the exception of our production coordinator, are lifelong Bay Area residents, and myself personally, I've been born and raised in the Bay Area, and real estate's been my only career in the
And actually,
Bay Area.
you have quite a reputation. I know I've mentioned your name to a few people who I didn't know they knew you, and they said, you know what, that guy's a good guy. In fact, he's allowed us to use his, I won't mention his name, but he's a well-known real estate attorney who actually invested quite a lot of money in your fund.
I've actually got 2 attorneys that are investors in the fund, and a financial advisor is an investor in the fund. So we do have references. We've got a reputation. That's all helpful. I mean, at the end of the day, is it possible? Is it possible for someone like me to make off with the money? Well, I'm not going to tell you it's not, because really, at the end of the day, we're all a product of our reputation, and that is something that we worked really hard at Pacific Private Money to gain the trust and through authenticity, transparency, in all of our affairs, and that is one thing that we strive hard to do.
Okay, we're going to cut to our second commercial break here. When we come back, Mark really does promise to give us the deal of the week.
Well, that's right. We're going to talk about specific loans.
Yeah, because I want the audience to really sink their teeth into this. And again, you're listening to Edward Brown and Mark Hanf on Mortgage Investing 101. Mark, how do people get a hold of you for more information?
So there's a lot of ways. Of course, you can always go to mortgageinvesting101.com, and that's the number 101 at the end of the word mortgage investing. So mortgageinvesting101.com. Then there's our company website, which is pacificprivatemoney.com. And just to really confuse you guys, we just launched a brand new website specifically for our mortgage pool fund, and that one can be found at pacificmoneyfund.com. Again, pacificmoneyfund.com if you want to learn more about our mortgage pool fund. And of course, you can always call or email. Our phone number is 415-883-2150, and if you call or email, I'm happy to send you an executive summary of our investment opportunities.
Great, and here is the second commercial break trivia question. Again, the theme is the movie Back to the Future, specifically Doc. What kind of car does Doc build the time machine out of? First 3 callers with the correct answer. I always wanted one of those cars too. The first 3 callers with the correct answer won a free 3-day, 2-night stay at the Lighthouse Resort. Their website is lighthouse4fun.com. Call 888-529-1134. That's 888-529-1134 to answer this question. What kind of car does Doc build the time machine out of? And again, we're talking about the movie Back to the Future. Call 888-529-1134. Make sure to include your name and your email address. Please speak slowly. Spell out your email 1 letter at a time. And don't touch that dial, because when mortgage investing comes right back, Mark will tell us exactly what deals he's working on. Can I make a suggestion?
Yeah.
If we were talking to a group of sophisticated real estate investors,
Yeah.
I get into the details of being, an individual investor, and how if you foreclose, you have to do the foreclosure yourself, come up with the money.
Right.
Because what you're trying to do is in that instance, you're trying to kind of compare and push people over to the fund. I would just talk about mortgage pool investing funds and how there's diversification and blah, blah, blah. If anybody calls you, you can always, if they say, well, I only invest in individuals, then go there. Because I just don't want to confuse the audience. I want to just get them the general idea of why it's good to invest in mortgage fund.
That's actually good. Maybe I'll do a clarification, because I think that bears clarification there for someone who's listening and might have gotten confused. Oh, you mean may have to advance more money?
That's what I'm saying. I heard that and I go, I understand it, but and I'm going to hit the bathroom all the time here. Water goes through me like water.
No, I'm the same way. Rick in our office, he and I are always battling for the bathroom. Drinking water, it's like every 15 minutes.
Well, that's good though. That's how you stay healthy.
I'm like pacing as I'm on the phone. I can't get off the phone. It's like I got my legs crossed 3 times, and it's like I gotta hang up and run to the restroom.
Excuse me. Now I've been uploading these to YouTube.
Yeah.
But I'm not doing too much caption type stuff. I know we wanted to have your guy do that. Did you want to go to that chamber thing? Did you see that?
I did see that, and I thought about it, but I really need to help with the move stuff.
Oh, that's right.
You got so much packing to do. And I don't know. I've never felt. I've gone to dozens of those chamber things, and of all of the networking that I've done, they're not typically.
Yeah.
Although again, I got to say, now before I was going looking for borrower deal flow, and now I'd be going there to talk about our mortgage pool fund paying 8%. So maybe maybe it's a little bit different, but
no, you have too much other stuff. It's going to be kind of short.
oh, did you got the math?
Yeah. What and you're moving to Hamilton, is it?
Belmer and Keys.
Belmer and Keys. That's right. Yeah. Okay, that's good. So did the house sell?
No. In fact, we haven't had to show it in over a week. So the landlord's been silent. We haven't told him we're moving out. We're just going to kind of, because I don't want him to want to come over before I'm ready. Because it's going to take a while to get the last stuff out, because there's still some things we're trying to sell on Craigslist.
And you've already had your rent paid for
through December. So, but December 1, he's going to be looking for money, and Lisa doesn't want to pay him anything. I don't want to pay him anything. So I said, no, come get.
Do you have a security deposit?
No, it's we paid. I applied it towards November, the security. He didn't like it, but it was like, dude, you're short selling it. You're booting us out with no warning. So spending $5,000 to move plus turning our lives upside down.
Oh yeah, that makes the move expensive. Yeah. Okay, here we go. Welcome back to Mortgage Investing 101. I'm Edward Brown, your host, along with Mark Hanf, president of Pacific Private Money. When we cut to the second commercial break, we asked this trivia question. Again, the theme is the movie Back to the Future, and specifically Doc. What kind of car does Doc build the time machine out of?
That would be the DeLorean.
A DeLorean, that is
Famous
correct.
DeLorean. I saw one of those. It's been a few years now, but it was painted because after a while that stainless steel.
Oh yeah, that's right.
Little, I guess
Weathered.
So,
Yeah.
so it looked pretty cool.
Yeah, I thought it was kind of a neat car.
So in the break, Edward, we were talking a little bit about we were wondering whether or not it's possible we may have thrown a couple of listeners and been a little bit confusing about this issue of foreclosure. And just for clarification's sake, when it comes to foreclosing on a loan that is in default, if you're an investor in our mortgage pool fund, you don't have to do anything. This is completely really irrelevant to you because
it's seamless transaction.
It's seamless because the fund manager, we are in the business of not only originating loans, but we have affiliations with companies that process foreclosures legally, and we would pay that cost. So it'd be, again, as a fund investor, your risk is spread among all of the loans in the mortgage pool, and so if there's any losses, which we haven't had any losses in 600 loans since 2008, but if there were a loss in a loan, that loss would be spread among all of the loans in the fund. And depending on the size of the fund, it's largely infinitesimal and generally has almost no effect.
You said that quickly. You've done 600 loans.
Yes.
And there's never been a loss?
There have been no loan losses, no loss of principal to any lender that has funded one of our 600 originated loans since 2008. Now, that doesn't mean there haven't been defaults, because there have been.
Yeah,
that's the nature of the business.
How many banks can claim that? I don't think any.
Well, yeah, not many.
Not many. Wow, so it's funny because it sounds like your loans are actually safer than banks' loans. Okay, so you know what? Let's get into the nitty-gritty. Give us an example, like a loan that you're looking at.
So right now, actually, we're going to close next week on a loan that, and this is a fairly typical example. It's a property in Elk Grove. It's a short sale. It was built in 2005. It's a gorgeous home. And get this, the buyer, who's also the borrower, made an offer on this property a year ago. So
at what price?
His offer was $295. In the contract, the accepted contract a year later is $295. We did an appraisal on the property. That appraisal came in with a low number, a quick sale number, fire sale number of $325,000 and a market value, 90-day market value of $350,000.
Okay, so he's getting a smoking deal.
He's getting, yeah, and that's typical in a short sale. You would expect in most short sales, although today's short sale profits, if you will, or the difference between market value is being squeezed a little bit more, but that's not atypical. So he's getting for $295.
$295. To make the numbers simple, let's say $300,000.
He's buying for $300,000, and it's arguably worth $350 as is. On an arm's length. Have plenty of time to market it, put it on the market.
Now, he's not going to live in it. He's
not. He's buying it. He's going to do. This one has very little remodeling to do. In fact, I think all he's going to do is paint carpet. I mean, literally paint carpet, because everything else is generally new, but it's been lived in for the last 8 years. So so it's got wear and tear.
Yeah,
right. So you go in, even if he paints the outside, inside, does little landscaping, carpeting on the inside. So he could spend $25,000 on that, put it back on the market, and maybe gets $375 or $380.
And how much are you lending him on this $300,000 purchase today?
70% of that $300,000.
That's $210,000. So in a deal like this, it actually wouldn't be bad for you if he never made a mortgage payment and you had to foreclose him out and buy and foreclose the property and get it at $210.
Right. So let's think of a scenario where we close and 30 days later he gets hit by a bus and he has no family members or whatever to step in, never makes a payment. We foreclose. We're going to turn around and sell that property for $325,000 or $350,000,
or put $25,000 in sell for
right. And the fund is going to
actually make a lot more than 8%.
Right. The fund's going to get all that, going to get that profit. Or what's more likely to happen, like I said earlier, we initiate a foreclosure. It goes to the courthouse steps as a trustee
Somebody
sale,
will
and somebody
step
else
up.
comes, steps up and buys it.
Buys it
That's
not only
exactly
for the
right.
210, but for all the late fees, et cetera. It might be
Exactly right.
220, 230, or
That's
whatever.
what's
And they'll
more
still get a
likely
great
to
deal.
happen, right.
And in his case, because this one wasn't actually speed, it doesn't sound like, because it was a long-term contract.
This was not a speed deal,
What
and
happened? Well, why does he need you instead of the bank?
well, because first of all, he's not going to live there. If it were an owner-occupied and he qualified for a loan, he could very likely get. In fact, he would be better off going to the bank. But in this situation, his credit is a little bit banged up. He's been a real estate investor for many years, and he's got a foreclosure. So he's got scores in the mid 600s, and it is an investment property. He intends to flip it, and banks don't like making short-term loans. That's the other nuance of this industry, that if you tell them it's going to be an owner-occupied and you qualify, you can get away with maybe buying it under the guise of it. Hey, Mr. Banker, I'm going to live in this property, but then all of a sudden, 6 months later, you sell the property. That happens, and people do it.
Yeah, the banks are getting very sticky. They
get
want to
pretty-
see. They want to see mail going there.
Yeah.
And they'll check on it nowadays. It's getting. You can't. It's not like the old days.
So basically, it wasn't a speed thing. It was the fact that this particular borrower didn't qualify, but it's not the first loan we've made to him, and so he's a repeat borrower client of Pacific
Okay.
Private Money.
What do you charge them on this one?
So this one, the note rate was 10% even, and we charged 3 points.
And what the audience doesn't know is that part of the good deal of dealing with you, Mark, and Pacific Private Money and the fund is that you split the points with the fund.
Well, that's one of the reasons why we're really bullish on our fund, and we do something that's a little bit unusual in the industry. If you're investigating mortgage pool funds, ask them if they share the origination points with the fund, and more often than not, what you're going to hear from the fund manager is no, we don't. Now, when we designed the fund, the gentleman at Fairway America who helped us and consulted with us to design a fund that had what they called the proper alignment between the shareholder and the fund manager, me being the fund manager and shareholders being, of course, the investors. One of the ways you do that is make it so that someone couldn't come up and say, well, Mark, what stops you from just charging more points in return for a lower interest rate if you get to keep all the points?
Good point.
Which is the argument for that a shareholder can and should make to someone who is not sharing his origination points with the fund. So we share the origination. We actually split. We provide to the fund 50% of the origination points. So we split it 50-50. The reason why we don't put all of the origination points into the fund is because I have to pay my commission over the sales agents out of that.
Sure.
And my agreement with all of my agents is a 50-50 split. So again, me as the broker, I'm not profiting personally from origination points, or the house isn't profiting from origination points, because the house share does go into the fund. And there's a couple of ways that really helps the fund shareholder and helps boost the yield, is that since a lot of our loans are short term, we could maybe re-lend that dollar out. Let's say we make a short term loan and the borrower pays it off in 2 or 3 months. Well, we can turn around and loan that money out again, charge points
more
again,
points.
and the points go in the fund. So again, the faster we can revolve the capital, the better yield that we can provide. So it's not, it's certain, within theory, we can potentially achieve in certain quarters an annualized return higher than 9%,
Sure.
which is our target is somewhere between 8 and 9. But again, depending on how the industry or where the demand comes in. And right now, we've got a lot of short-term demand, and that again is good for the shareholder.
And something else the audience doesn't know is you bore all the costs of putting this together.
It's interesting that I went to a number of different events that were presentations about how to create a mortgage pool fund. And there's a company that is in the business of putting on these events twice a year, once a year in Vegas, to talk about that. And they always promoted, and I first heard about this in 2007. What they said was, all these great things about why you as a loan originator want to have your own mortgage pool fund. And one of the things that they said is, whatever you spend putting it together, you get paid back by the fund. And I always thought that was curious and wondered how that could possibly be because
It's almost like a loan.
I was a specialist. I mean, numbers were my thing. I mean, I specialized in accounting and finance out of college and spent my first 20 years doing mostly number crunching and accounting and finance for a development company here in the Bay Area. And so I understand how the math works. You can't just go raise millions of dollars in a mortgage pool fund but pay yourself back for the cost of the fund and not have that impact the yield to the shareholders.
Absolutely.
And so, in fact, that's a knock that many people have on funds in their first year, claiming that the yields are really lousy in the first year because of the high expenses. Well,
That's not fair.
It's not fair, right?
Not
And
fair.
so what we decided to do at Pacific is we picked up the cost of the expenses and bore all of the formation expenses and the initial expenses in the fund.
Okay, now I know you said we only have a couple of minutes left here. You said your targeted yield was 8% or more.
8.5.
8.5%. Is there a minimum that you are giving a preference to your investors?
Yes, there is a preferred return of 7%, and we chose 7 because we're lending in the San Francisco Bay Area, and the market here is very competitive for hard money and private money loans, more so than any other region in the country. And I know that because I go to national industry conferences and talk to people in other markets. And when we make loans, I mean, it's not unusual for us to make a loan of 8 to 8.5% if it's super low LTV. Maybe it's a San Francisco property with an A-paper borrower who just needs a fast loan and doesn't want to mess around with the banks.
Okay.
So we needed to design a fund that would give us the option to be competitive to get those excellent loans. We wanted it to be conservative. We didn't want to promise, oh, we'll do a fund where we're going to pay 12% or 14%.
Too risky.
Well, in this market, in the Bay Area, absolutely. If anybody who has a fund in Northern California who's telling you they're paying double-digit returns, I'm going to show you a fund that's making risky deals.
Yeah.
You just can't do it and be competitive. We don't want the lousy loans. We turned down 15 out of 20 loan requests just on the initial phone call.
Well,
We're cherry picking.
that's why at 600 pounds, no one's ever lost money.
Right. So when you cherry pick the best deals, you want to be conservative.
So this is our last shot to tell investors
That's right.
how to get a hold of you.
So for more information, my company is Pacific Private Money. I'm based in downtown Novato on Grant Avenue in Marin County. Our website is pacificprivatemoney.com. Our fund website is pacificmoneyfund.com, and our local phone number is 415-883-2150. Go ahead and call today or Sunday. Leave a message. We'll give you a call next week and shoot you an email with information about the Pacific Private Money Fund.
And you can always go to our website for the show, which is Mortgage Investing 101.
For podcasts.
For podcasts. So tune in next week to Mortgage Investing 101. We're going to be giving away more free vacations for answering trivia questions and giving more valuable information about mortgage investing. Thanks for listening. I'm your host, Edward Brown. And on behalf of Mortgage Investing 101, so long. We'll catch you next week.
Do you like recycle the same piece of tape?
Yeah.